This 10-minute deep dive is a brutal real-time deconstruction of the last 5 days, during which the global financial order completely transformed. Before we look at the chart of this major asset, you need to process the hard macroeconomic shift that the retail crowd has entirely missed. Look at this long position opened inside our operational terminal on May 15 at the exact psychological baseline of 79,127. While standard retail accounts panic over localized corrections and liquidations, our focus remains on a cold systemic strategy that operates beyond daily market volatility. We do not guess lines or engage in emotional trading patterns because we capture structural progress driven by physical macroeconomic catalysts. This ongoing market dump is not an unexpected catastrophe but a highly predictable repricing of risk as the old credit-dependent framework crashes into a wall. While weak retail hands scramble to dump their assets at a catastrophic loss near the 76,000 zone, institutional players are maintaining strict discipline. We refuse to argue with the overarching thermodynamic realities of global liquidity because wealth protection requires real physical understanding. The SEC executed its aggressive push to tokenize the massive $126 trillion traditional equity apparatus, permanently tying digital liquidity to global collateral matrices. This institutional realignment immediately wiped out over $661 million in over-leveraged speculative futures within hours, forcing Bitcoin out of its isolated sandbox into a brutal reality where paper clearing houses lose total control. Simultaneously, the United States Treasury entered a state of maximum fiscal panic as the 30-year bond market spiked to unviable levels, proving that traditional Western financial instruments can no longer mask the terminal decay of fiat compliance. While Washington attempted to enforce mandates, global liquidity executed a coordinated flight. Japan initiated an aggressive offload of $47.7 billion in U.S. sovereign debt, forcing Treasury Secretary Scott Bessent into a state of absolute administrative panic. Immediately following the Beijing summit, China canceled another $41 billion in contracts, moving away from fiat debt. Concurrently, the dismissal of Elon Musk's lawsuit against OpenAI officially solidified centralized corporate monopolies over Western artificial intelligence infrastructure. When courts openly protect corporate monopolies and the internal system bleeds $1.4 billion a day to domestic fraud, true computing autonomy cannot rely on Western legal neutrality. Abstract asset classes turn into immediate liabilities for multi-billion-dollar investment funds. With crude oil prices surges past $108 per barrel amid intensifying geopolitical ultimatums, the Trump administration has no choice. Guided by America First and America for Americans, the White House is liquidating its non-performing foreign liabilities to save its own domestic economy. Look closely at the European theater right now, where geopolitical stability has functionally shattered. In Strasbourg, Angela Merkel is aggressively demanding immediate, restrictive mandates to crush independent artificial intelligence developments under the pretense of administrative safety. This regulatory dogma is designed to mask the terminal degradation of the Eurozone's heavy industrial capacity. While local politicians choose total bureaucratic isolation, their infrastructure is suffocating under an obsolete, high-cost power network that pushes grid baselines past 8 cents per kilowatt-hour. Simultaneously, the NATO security umbrella has completely dissolved after military leaders publicly admitted that Eurocentric independent defenses are pure nonsense. The sudden implementation of high-alert air defense operations near Vilnius proves that holding digital nodes in these friction zones is an unmanageable risk. Even traditional offshore safe havens across the Middle East are losing their structural predictability under expanding geopolitical escalation. The recent explicit warnings from nuclear oversight bodies regarding vulnerability of critical generation in the UAE have completely shattered long-term asset insulation strategies. When critical deep-sea data cables and strategic energy choke points face direct physical threats, paper wealth turns into an immediate liability. Crude oil holding near $109 per barrel proves that traditional financial risk hedges are entirely obsolete during systemic infrastructure warfare. We have entered the era of the hard energy standard, where computing capacity requires direct physical permanence on unkillable landmasses. Wealth validation cannot operate on speculative narratives. It demands absolute proximity to independent, localized raw power generation that remains untouched by global conflicts. While retail accounts chase imaginary chart patterns, sovereign desks are shifting liquid reserves toward tangible industrial assets. Capital is migrating away from debt-backed political promises, seeking environments where the physical infrastructure itself guarantees absolute operational predictability and deep structural protection. True preservation of international liquidity requires moving away from virtual proxies into structural energy nodes. While traditional operators struggle with public utility costs, advanced asset allocation demands direct deployment into unkillable physical capacity. We have engineered an isolated infrastructure layer that integrates high-density technological processing directly with continuous, primary power generation. This layout bypasses standard commercial grid weaknesses entirely, establishing a localized loop of complete operational predictability. By capturing raw, low-cost baseline resources at the source, our ecosystem secures an immutable cost advantage that paper markets cannot dilute. This approach transforms energy volatility into a defensive shield, stabilizing computational output regardless of external regulatory or physical friction. Sophisticated capital does not seek temporary speculative hedges, it requires permanent integration with primary industrial foundations. True data safety and structural wealth insulation exist only where technology is physically welded to sovereign, self-sustaining generation landscapes. This economic reality is why forward-looking liquidity is bypassing traditional Western clearing networks entirely. The global alignment has created clear parallel channels, allowing institutional wealth to safely rotate into independent resource hubs that operate completely outside unilateral debt jurisdictions. Our architectural design operates strictly within verified, fully compliant legal frameworks, providing a white institutional loop for foreign assets. Every hardware element is backed by material pledge structures, ensuring total corporate protection under transparent regulatory oversight. The allocation process is governed by algorithmic automation, utilizing strict split execution protocols to eliminate human risk from the operational cycle. Incoming yields and infrastructure maintenance and split instantly, delivering clean capital returns directly to secure, autonomous custody. While the old system bleeds through administrative corruption and grid failures, this parallel infrastructure loop guarantees a predictable refuge. We are not predicting the multipolar transition. We have already built the heavy physical ground where serious global wealth can successfully realign. Look directly at the operational asset matrix right now, where gold is aggressively shattering historical records, holding firmly past the 4,500 baseline with a powerful buy signal. This massive surge in gold price is not a speculative anomaly, it is the ultimate empirical proof that the global flight from paper fiat debt into hard physical collateral has entered its acute phase.